This is Steve Colano, and this is Confidential Remarks. In late 2024, the residential real estate market braced for a structural correction. The National Association of Realtors settled a $418 million antitrust lawsuit, a decision that eliminated the rule forcing sellers to offer buyer-agent commissions through the MLS. Economists and consumers alike expected this regulatory shift to crash percentage-based commissions and break a decades-old pricing standard. Instead, the opposite occurred. By mid-2025, national average commissions actually rose from 5.32% to 5.44%. To understand why the market defied basic economic gravity, we have to examine the baseline extraction of a median transaction. On a typical $400,000 home sale, a total of $39,660 is lost to the closing process itself. This is pure transaction friction. It is capital flowing entirely to third parties, completely separate from the buyer's down payment or the seller's actual property equity. This high cost persists even as the rapid adoption of artificial intelligence has driven the cost of producing property information, valuations, and marketing copy effectively to zero. This persistence suggests that commission rates are decoupling from the market value of the tasks they ostensibly cover. Surviving this market requires stripping away systemic bloat through a line-by-line operational audit, isolating exactly where actual human judgment is still occurring. We start the audit at the macroeconomic level. This chart shows the complete line item breakdown of that $39,660 in total transaction friction. Notice the deep imbalance in how this cost is distributed between the two parties at closing. The seller absorbs the vast majority of the penalty, losing $30,200, roughly 76% of the total friction, directly from their proceeds. Within that massive share sits a single expense that dwarfs every other cost combined. The total commission block accounts for $23,000, representing 58% of the entire transaction friction. The buyer's 24% share is much smaller and heavily concentrated in structurally overpriced lender origination and title insurance fees. Because commissions dominate the loss of equity so completely, they must be the primary target for any meaningful cost correction. Zooming in on that seller side reveals a complex routing system for those commission dollars. Most consumers assume their 3% listing fee flows directly into the pocket of the agent they hired. This flowchart illustrates the actual path of the money, starting with the seller's gross $12,000 payment for a standard listing. Before the brokerage even processes a split, an embedded platform tax intercepts a massive portion of those funds. Corporate referral networks, like the Zillow Flex program, instantly extract up to a 40% cut right off the top. On a median sale, that single deduction equates to a $4,800 loss. Only the remaining $7,200 finally reaches the standard 80-20 division between the agent and their broker. The capital originally intended to secure dedicated professional representation is instead being quietly diverted to fund massive corporate lead generation algorithms. Now we audit the actual labor the seller receives in exchange for the remaining commission. The work bundles neatly into a two-tier framework, separating tasks commoditized by artificial intelligence from those demanding human judgment. Tier 1 consists of the strictly administrative and information gathering tasks. This includes generating comparative market valuations, managing MLS data entry, and writing listing descriptions. Historically, the market valued this administrative bundle at upwards of $3,350 per transaction. Today, a seller equipped with well-prompted AI tools can replicate this entire output for the cost of a $30 monthly software subscription. Tier 2 represents the irreducible human core of the transaction. This encompasses live negotiation execution, emotional steadiness through high-stakes decisions, and on-site physical property assessment. Analyzing comparable professional services places the maximum fair market value of this Tier 2 labor pool between $2,000 and $6,500. The traditional commission structure artificially prices Tier 1 administrative work as if it were still scarce, obscuring the actual economic value of the services rendered. In 2003, economists Say and Moretti identified a severe structural flaw in this model. The effort required to sell a home does not scale linearly with the price of the asset. This chart visualizes the widening gap between the fixed value of human labor and the linear growth of percentage-based commissions. On a median $400,000 home, sellers pay $12,000 for a service bundle that contains a maximum of $6,500 in actual labor value. Scale that to a $1.5 million luxury property, and the seller faces up to a 2,050% overpayment for the exact same human effort. In a functioning market, competition would quickly eliminate margins this wide. The margins persist due to systemic steering, a mechanism that imposes strict economic penalties on anyone attempting to defect from standard rates. Peer-reviewed research shows that homes listed with discount buyer-agent commissions take 33% longer to sell and face a 75% higher probability of never selling at all. The other anchor keeping costs high is pipeline risk. The no-deal, no-pay structure means the commission from one successful closing must heavily subsidize the agent's time spent on multiple expired listings and failed efforts. These commission rates function as a subsidy for the industry's high pipeline failure rate and a necessary hedge against the documented penalties of steering. This dynamic mirrors economist George Akerlof's market for lemons, characterized by severe information asymmetry regarding the actual skill of the labor pool. This graphic shows the scale of the issue. There are roughly 3 million active real estate licenses nationwide. Despite that massive saturation, the median agent executes only 10 transactions per year. Consumers bear the full weight of this asymmetry, lacking any reliable mechanism to identify top decile talent before they sign a binding listing agreement. Sellers are forced to pay the premium standard rate, blindly hoping the person representing their largest financial asset is not merely a median operator. New alternative operational paths have emerged to bypass this bundled risk entirely. Models like flat fee MLS access and a la carte hourly billing decouple payment from pipeline risk, reducing costs down to the actual labor provided. By choosing these unbundled alternatives, a median seller retains an additional $9,000 to $18,000 in equity at closing. The industry can no longer extract value by guarding administrative tasks. The future belongs to models that exclusively monetize high stakes, purely human judgment. This has been Confidential Remarks.